This is a demonstration of the second part of the comprehensive tax allocation problem, and this will be for the year 2020. For this year, we have the same type of schedule that we had for 2019, where we're going to start with pre-tax financial income and make the adjustments to determine taxable income times the tax rate, and that will give us income tax payable. We'll go down to the bottom now and see where we got our information for this year for taxable income, and it gave us pre-tax financial income for 2020 was $504,800. Our tax rate is 20% for this year and future years, and we had one permanent difference for this year, non-taxable municipal bond interest revenue of $24,000. So now we will have the information we need to look at for 2020. We take pre-tax financial income, and then we're going to subtract that municipal bond interest of $24,000, and then I like to show a subtotal. Now, the first thing that I have done on my schedule is go ahead and show two of the items where we have reversing temporary differences. So we know that in 2019 we had installment sales of $448,000 that were going to be collected evenly over the next 4 years. So we're beginning to see those amounts begin to be collected, with $112,000 collected this year, and then we have another $336,000 to be collected in future years. So again, to be able to determine our deferred tax liabilities and assets at the end of the year, we're going to add those amounts together, or sum those $336,000 times 20%, and that's going to give us, for those reversing amounts, a $67,200 deferred tax liability. We also will begin to be able to deduct for this year $56,000 for warranty repairs that we actually paid for this year, and then we're going to so that's going to be an additional amount subtracted to get to taxable income, and then in the future we'll have another $100,000. So the $100,000 is a future deductible amount, so when we multiply that by 20%, we have a deferred tax asset of $20,000. So those are just reversing amounts that were scheduled for originating amounts that occurred in 2019, and that's what the problem gives us in this first item. Is it does tell us that they have now collected the $112,000, so that will become part of taxable income, not included in pre-tax financial income for this year, and then there are the remaining amounts. However, the company is continuing, of course, in business, so now they have completed 4 additional new contracts for this year, and they're using that same installment method. They're allowing them to pay for them evenly over the next 4 years, but they didn't collect any money this year. So the whole $256,000 would need to be subtracted to get to taxable income, and we will be collecting those amounts over the next 4 years. So that would make us have a deferred tax liability when we multiply it by the total by 20% of $51,200. Now the depreciation is the same schedule that we had for 2019. So these amounts that we're showing here are just the amounts that we had originally scheduled up here for 2019. So we'll just look at those. And those are actually, we could consider those to be reversing amounts. They were the amounts that we scheduled out, and none of those have changed. I didn't include them under reversing amounts. I did just put them in the originating amounts, but they could be considered reversing. When we add those together for this year, we get a $100,800 difference. and that's going to be a deferred tax liability because we're going to have less of a deduction in the future because it's accelerated. We've taken more of it up front. So a total of $20,160 for that deferred tax liability. Now we're going to talk about the warranty expense. As I said, I scheduled the reversing warranty payments for 2019 up in the top. So what we're going to look at now is the new warranties that we had for our products for this year. So it's a little bit confusing how the problem is set up because it combines both of the years together. I think it makes a little bit more sense if you show them separated. So let's just look at the new warranties for this year that were recorded. So warranty expense for this year was $180,000, and then the amounts we actually paid for warranty repairs was $50,000. So the excess amount for this year is $130,000. So that would have to be added back, and then we expect to pay those amounts over the next 2 years. So for that, for the warranty expense, we would have a deferred tax asset of $26,000 when we multiply the $130,000 times the tax rate. So the problem combined them. That's the reason why we see where they're showing, because the liability account would be equal to the beginning liability that we had of $156,000 for the prior year. Then we have our new expense for this year. We have the amounts we actually repaired for last year and the amounts that we have already repaired for this year. But I just broke it down into two separate ones because I think it makes it a little easier to understand. We do have one other temporary amount that we didn't have last year, and that's a loss accrual. So let's look at that real quick. Almond accrued a loss of $172,000 for financial reporting purposes because of pending litigation, and we know that won't be deductible until they actually pay that amount out, and they don't expect to do that until 2028. So that loss would have been deducted to get to pre-tax financial income, so we're going to have to add it back, and we show that reversing in 2028, and that will result in a deferred tax asset because that deduction we'll be able to take in the future. So multiplying that by the tax rate, we get a deferred tax asset of $34,400. So looking at the balance sheet presentation, we can see that it's beginning to get a little bit more complicated than we had before in 2019 because we have beginning amounts. So the beginning amounts from carrying over from 2019, if you remember, our ending balance was $31,200 for 2019 and $93,200 deferred tax liability for 2019, and we can go back up here and just look at those real quick. So those are where those beginning balances are coming from. So now we're going to measure the ending amount. So how do we do that? We add up all of our assets. So we had a $20,000 deferred tax asset for the remaining amounts of warranties for 2019. We have more warranties, deferred tax asset for this year for the warranties for 2020, and then we have the loss accrual. So when we sum those three deferred tax assets at the end, we get $80,400. We do the same thing for the three deferred tax liabilities for the installment sales remaining to be collected for 2019, the new ones for 2020, and then the accelerated depreciation. So when we add those three amounts, we get a total deferred tax liability of $138,560 for this year. So to get the actual net amount to report on the balance sheet, we net all of these together and it still comes out to be a net deferred tax liability, and that would be shown on the balance sheet as non-current. And if you notice, when we schedule out the reversing amounts in the future and multiply those by 20%, we get the same number. So that's a good way to check your balance sheet to make sure that everything is calculated correctly. Now, this is where the calculation of the deferred tax expense, we can really see how it actually occurs, because now we do have beginning balances. So in order to determine the deferred tax expense just for this year, we are going to take that ending balance that we just calculated. We're going to subtract the beginning amount, and that's going to give us our deferred tax benefit for our deferred tax assets for this year of $49,200. We're going to do the same thing for our deferred tax liabilities. We added up the ending amounts, but now we have to subtract what we had at the beginning, and now we're going to get our deferred tax expense from our liabilities of $45,360. So it's interesting because when we net those two amounts, which is what we do to determine the overall deferred tax expense or benefit, this year we actually have a deferred tax benefit of $3,840 when we net the deferred tax benefit from our deferred tax assets and our deferred tax expense from our deferred tax liabilities. We see that we actually had a net deferred tax benefit. So when we're calculating our income tax expense for this year, we take income tax payable right off the tax return like we always do. And then we're going to actually subtract that deferred tax benefit, and income tax expense for 2020 is going to be $96,160. Now for the income statement, we start out with income, financial income before income taxes, which we were given. We show the current amount that we owe on our tax return, which is $100,000. We subtract from that the deferred tax benefit, and we get our income tax expense overall of $96,160. Now we can record our journal entry by debiting income tax expense for $96,160, debit our deferred tax asset, the net amount of $49,200, credit deferred tax liability for $45,360, and credit income tax payable for $100,000. And that is the conclusion of the demonstration of Part 2 of the comprehensive tax allocation problem.